Welcome back everyone to the Fintech and Blockchain course, and today we will be talking about regulatory technology and supervisory technology. These are very important because traditionally financial services is a highly regulated sector. And if we let new companies, new technology companies into the financial sector, then ideally should have been regulated as well. But the question is how? This is the focus of our session today.
So hi, I'm Randeep Buttar, and I'm the founder of Compliance as a Service Limited, which is a Regtech company that helps financial services institutions enhance the way in which they achieve compliance and deliver regulatory reporting. In addition to this, I'm also an interim director at HSBC, where I look after risk data transformation and innovation. I would suggest this actually quite adequate, given the fact that most of the regulations that have come out of Europe since the great financial crisis address the underlying root cause issues that we had. So, for example, if you take the Basel III Accords, these are really about ensuring that we have the right quality of assets on our balance sheet, and that where we do have risky assets, they are offset by good quality capital. And so, from my perspective, when it comes to addressing things like the need for ongoing liquidity in the event of a liquidity dry up, then absolutely the regulations are appropriate. I mean, that's just one case in point. There are many others. So I wouldn't suggest that they're strict. I think that they're a direct requirement and absolutely needed. I think the key challenge for banks here is the volume of regulations. So there are so many regulations out there that whenever a new one comes on board or whenever an existing one is changed, banks have to respond. Typically in compliance, you tend to throw people at the problem, and that just leads to an increase in headcount, which obviously, given the pressures that we have at the moment to cut costs across the industry, it's important that we get a little bit more smart and clever about how we address this. So what we don't want to do is start from scratch. What I think we need to do is actually look into ways in which we can determine the overlap between regulations. So that's one. I think actually understanding how you can inherit regulation or compliance that you've already achieved from a previous regulation to meet a new regulation is another. And so the strategies really center on understanding how various regulations map back to your enterprise, and therefore you can better determine your impact and also better plan against a future requirement. So I think it needs to be a combination of the two. I think ultimately there's a lot of internal in-house knowledge capital that needs to be leveraged whenever you're trying to address a regulatory compliance issue. However, having said that, the Regtech market itself is projected to be valued at around 2.8 billion by 2025. And so in light of that, we know that there's a burgeoning ecosystem. There's a lot of specialist companies out there where they can demonstrate an expertise in a given regulation. We should absolutely be looking to partner up with them and lean on some of that good work. Absolutely. So I think there's a lot of potential for artificial intelligence and machine learning in the context of regulatory technology. In particular, when I think about reg reporting, absolutely, we need to have the ability to leverage those types of tools. But in order for us to do that, there is a first step, which is having clean data that we can model on. And so the clean data will come from digitizing the regulation, disambiguating it, mapping it back to effectively data and information that models your enterprise. Then you can start doing interesting things with machine learning. So when a new regulation comes on board, you can then determine how that regulation can be mapped to existing areas of your enterprise and also map back to other regulations too to determine the overlap between them. In addition to that, I would say that you also can use it to then start modeling other things like the cost of compliance, the future cost of non-compliance, the impact of a change in regulation, change in policy. So absolutely, I think there's potential for AI and machine learning here. I think it's still early days for Suptech. It's definitely an area that is going to start growing quite vastly. So if you look at the regulators themselves, in particular the ones in the UK, they are wholly embracing innovation. So they're definitely driving in that direction. But again, this is all about data. The regulators and the supervisors, they want to understand whether or not a systemic risk is coming and where it's going to come from and how it's going to arrive. In order for them to do that, they really need to have standardized data collected from across the industry to make those sorts of inferences. So I think there's certainly an opportunity for startups to get involved in Suptech when they understand that need and that challenge and actually start contributing solutions into that dialogue. That's where you'll see a lot more traction as well from the regulators. And certainly you're seeing it today anyway through things like sandbox initiatives and accelerators. From my perspective, the outsourcing companies should really be providing features and technology that would be useful in this context. Now, a lot of that is going to be quite generic. So, for example, do I really need to understand the nuances of specific reg in order for me to implement or provide a solution around natural language processing, text analytics, semantic stitching, data matching, workflow, that type of thing? These are all the sorts of features that I think are important in the context of reg reporting. And I don't necessarily believe that the outsourcing companies or the startups need to really understand the underlying regulation in order to provide those types of generic and transferable technologies. Having said that, I think it's absolutely valuable if they came up and pitched and did it in the context of a specific regulation and they show a demonstrable knowledge of that regulation, then absolutely it's going to benefit them. It's going to certainly make them a more preferential option. What I'd also say is that you will never get away from the fact that in-house within the banking organizations themselves, you're going to have a lot more knowledge about the regulations. So, it doesn't have to be too deep, but there should certainly be an appreciation and an understanding. I would say the biggest challenges at the moment are the increased levels of demand. So the volume of regulation that's hitting the industry is high and it's continuing to rise. In addition to that, I would also say that it's regulatory scrutiny. The regulators want a lot more information. They want it at a lower level of grain and a lot more frequently than they have done in the past. And so that's also a challenge, is being able to actually source that data, that information to provide a response. And then finally, I would say it's regulatory fragmentation. So at the moment, you have divergence, sometimes within a country, because you can have situations in the US where you have state versus federal regulators looking at the same regulation in different ways. Similarly, I guess across Europe, where you have EU member states, they legislate in different ways to different directives, or rather the same directive. And so you're seeing a variance in the way in which regulation is being interpreted and also translated into law. And I think that there is the need for more equivalence across the industry. I'll say that's probably also one of the key challenges.
So the central bank everywhere now have to face at least these 5 challenges. The first one is the problem of connectivity. The second is the risk of digitalization. The third is obviously strengthening regulation. The fourth is changes in consumer behavior. And finally, in measuring impact, especially in the case of economic development, poverty reduction, financial inclusion, and stuff like that. Connectivity will drive digitization because we are now being connected from anywhere around the world. Whether you are living in Asia or Australia or America or Europe or anywhere around the world, you will eventually be connected. And this connectivity will be made possible through digitization. That's why digitization is very important nowadays, because it increases the rate of our connectivity. From our previous session, we know that technology is changing the financial sector by using state-of-the-art technology like artificial intelligence, blockchain, digital identity, and then they use the technology to provide new digital financial services, as well as the use of big data and analytics combined with machine learning that we have discussed in the previous session. Those kind of things are the forte of financial technology companies and usually not available in the incumbent banks. That's why it will create new, different dynamics in the financial sector. Other than that, we also have to consider the importance of digital identity because digital identity is crucial for inclusive economic growth. We need digital identity to increase inclusion because by having digital identity, we can increase our universal coverage and universal accessibility. Digital identity is also important in designing robust, secure, responsive, and sustainable system. And finally, digital identity is also important for increasing governance because we can use this to build trust and protect privacy as well as consumer rights. Indeed, payments, data, and distributed ledger or blockchain will help determine the future of financial services because we can implement those technology to help us in payment disintermediation. We can also use this to exploit our data and combined with machine learning and artificial intelligence, we can develop new and better services and products to the customers. And by using blockchain or distributed ledger technology, we can increase the efficiency of our business process. So it will enable business process improvement in many different areas. From the perspective of the central bank, there is also a concern on the central bank digital currencies. We also have mentioned about this in our previous session. Central bank digital currencies or CBDC can be retail or wholesale and backed by a central bank. Retail CBDC provide individuals with access to a digital version of central bank fiat money, while wholesale CBDCs are limited to financial institutions focusing on interbank settlements. The thing here is that while crypto assets can be used as a means of exchange, they are not considered to be a currency or money just yet. That's why we came up with different kind of things like regulatory technology, supervisory technology, and regulatory sandbox. I'm sure you are already familiar with regulatory sandbox because we already mentioned about this several times. Regulatory sandbox essentially is a kind of initiative to live test new products, new services, or new business models real time, but on a very limited basis. If the fintech company has passed the regulatory sandbox, then they will obtain full license to operate as a bank or as a financial institutions. But what about regulatory technology? Regulatory technology or Regtech is the use of technology to automate regulatory compliance or oversight processes. Supervisory technology is the use of innovative technology by supervisory agencies to support supervision. So there is an intersection between Regtech and Suptech. There is an overlap between Regtech and Suptech. And the thing here is that we have to be very careful because policy needs to precede technology. Policy should be able to anticipate what will happen or what will come out of the technology. Anyone knows about FATF? FATF is a Financial Action Task Force. So essentially, if we have an effective FATF, then it will be good for our economic growth. In the Asia-Pacific region, there is the Asia-Pacific Group on Money Laundering. These organizations or this task force work together to ensure international standards against money laundering, terrorist financing, and proliferation financing related to weapons of mass destruction. And they will focus on things like national risk assessment, capacity building on supervision and enforcement, implementation of recommendation from mutual evaluation, collaboration with international agencies, digital compliance technology, this is the thing that we will be focusing on, and support to private sector institutions. And nowadays, we know that cybersecurity is very important because cybersecurity is a key risk facing financial systems and fintech application. So that's why it is important for us to have clear legal and regulatory standards as well as guidelines. And we have to ensure that our financial technology solution must be safe and must be trustworthy. So the focus of the government anywhere is to promote secure and interoperable payment systems. The payment system should be interoperable, it should be inclusive, it should be cooperative, and it should be competitive. Without that, we will not be having a good payment system, especially pro-poor payment systems. So if we want to have financial payment technologies, then it should be based on those principles: interoperability, inclusivity, cooperation, and competition. The government is also focusing on balancing innovation, risk, and reach. They will continue and further develop regional and international cooperation, focusing on cybersecurity, focusing on anti-money laundering and combating the financing of terrorism. They will also focus on legal, regulatory, and supervisory frameworks. They will also increase the efficiency of interoperable payment and security settlement systems and cross-border payments and remittance as well. So as I mentioned in the previous slide, regulatory technology is basically the adoption of new technologies to facilitate the delivery of regulatory requirements. It aims at improving risk management and compliance at financial services providers and banks. It has potential to enable more efficient and effective regulation and compliance. And according to IBM, Regtech goal is to shift the risk/cost curve. So they want to meet compliance requirement without a one-for-one increase in cost. They will increase the compliance and accountability, but on the other hand, they want to reduce the cost for that too. And supervisory technology is the use of innovative technology by supervisory agencies. It aims at supporting financial supervision by using sophisticated technological tools like big data analysis and machine learning. The two main areas of application at this moment is data collection and data analysis. And nowadays, there are several supervisory agencies already using Suptech for risk-based supervision. And by implementing this technology, it has potential to enable more efficient and effective regulation and compliance. For example, we can use Suptech for digitalizing reporting and regulatory process. We can also use Suptech for effective implementation of the risk-based supervisory approach to supervision. So supervisory technology will combine different tools or approach in data collection, as well as different technologies in data analytics. It has also been implemented in, for example, by Australian Securities and Investment Commission, by the National Bank of Rwanda, by the Monetary Authority of Singapore, by the Bank of Italy, and so on and so forth. But then there are also risks and challenges posed by Regtech and Suptech. For example, we have to focus on industry main points. We have to focus on KYC, know your customer, and AML, anti-money laundering. And it is very difficult to do because nowadays financial crime is also increasing and they also becoming much more sophisticated than it was before. We also need new tools to verify our identity using things like biometrics, machine learning, and even develop new digital identities using blockchain or distributed ledger technology. We also have to focus on monitoring transaction because our system nowadays still produce very high false positive rates. That's why we need more efficient risk assessment and more efficient processing of alerts that would reduce time spent reviewing the false alarms. And the risk for this can be very high because, for example, JP Morgan has fined over 30 billion by Irish Central Bank for weak AML controls between 2013 to 2016. And more importantly, we also have to focus on the transparency of our Suptech model, because innovative tools will obviously involve complex application of data science and algorithm, making it difficult for regulators and supervisors to understand the models. That's why we will need different approach for audit and investigation as well. And to conclude, the adoption of innovative technology by regulators support a proactive approach to risk management. This is what we call by risk-based supervisory approach. Regtech presents the regulated entities with potential cost benefits by shifting the risk/cost curve. So it enables us to meet compliance requirements without a one-for-one increase in cost. And finally, automating the interpretation and monitoring of regulatory obligation through Regtech has the potential to free up time for compliance staff to focus more on analysis instead of tedious administrative tasks. So that's all for today's session. I look forward to see you in class. Stay safe and stay healthy. Bye for now.